Trump's tariffs are still in place. That's after a U.S. federal appeals court temporarily paused a ruling from the U.S. Court of International Trade that had said a lot of these measures were not justified on the emergency basis that Trump has been using. Let's get more from Neil Linsdell, Head of Investment Strategy at Raymond James. Neil, thanks very much indeed for joining us.
Great to see you again, Andy.
Even before this appeal court ruling, you said, you know, this trade war is still on and the Trump administration will look for other avenues.
Yeah, exactly. I mean, even though we did see this court case, you know, it was a unanimous decision by 3 judges. And, you know, the powers that have been given to Donald Trump don't really extend to granting the tariff measures that he's taken under IEEPA right now. But there are other measures under different sections, 122, 201, 232, and 301 that we're looking at him, you know, taking more extensive use of.
Some of these measures, though, apparently are more cumbersome. Some could take months to implement.
Yeah, exactly. And that's why we think he went with IEEPA initially, because under his understanding, or under the administration's understanding, it was quick to be able to put these things into play. And he had a lot of extensive powers to increase the tariffs where he wanted to put them. So if you take a look at where we think he might go with this, or where we think the administration might go, under Section 122, the president can put up to 15% tariffs, but that's only for 150 days. And that would be in response to payments imbalance with other countries. So we think that that's a measure that he might fall back to. But while he's doing that, there's all these other sections, 201, 232, and 301 under the Trade Act of 1974, which, you're right, they will take longer to be able to do the investigations, but 301, he can put tariffs on specific countries, 201 on specific industries, and 232 on specific products.
How should investors, is there a clear way for investors to even think about this, how to navigate this environment?
Well, we're still seeing a lot of the impacts of the tariffs coming into Main Street. So Wall Street and Bay Street reacted very quickly, obviously, to the tariff headlines. But some of these things are just starting to work their way into the economy now, and we're just starting to see them as far as cargo shipments, increased price levels of things in June. Investors, if they're looking at the equity markets, though equity markets always anticipate what's going to be happening by 6, 9, or 12 months. So by the time we see this actually creep into the economy on a real life basis, you're going to see the equity market start to reflect what might be a more normalized environment that we could be looking at next year. So investors are soon going to start looking at, well, what's 2026 going to look like once all this noise kind of dies down? You never really know when this trigger point or the switch is going to happen. So, I mean, the best approach is always to remain diversified in your holdings.
So you wouldn't advise a shift, say, in asset classes because of this trade war?
Well, I think going into this trade war, going into all this headline noise, as long as you held a well-diversified portfolio, you probably did quite well. And, you know, we have over 500 Raymond James advisors across the country, and, you know, they've been really good at setting up their clients with well-diversified portfolios so that when we do get this headline noise, when we get these quick reactions, you know, clients are well prepared for this type of reaction, and the portfolios are well balanced to be able to deal with this noise. Because if you're looking, you know, 5, 10 years down the road for your portfolio, what you expect out of your portfolio to achieve your objectives, then it's always good to have that balance. So, I mean, you can play in the short term and try to figure out what's going to happen next, but when you could get a 5% swing in the market based on a social media posting next week or tomorrow or this afternoon, you know, you have to look at the long game when you're on the investment side.
Just to switch gears here a little bit, you probably have heard about this measure in Trump's tax and spending bill that would apparently penalize foreign investors on the returns from U.S. investments. if our governments have the temerity to put in tax policies that Washington doesn't like. Now, apparently Washington is alarmed at that because it would threaten to cut off flows of capital from overseas. Do you think the administration will follow through on that measure? Because it could affect Canadians' returns from US stocks, for example.
Yeah, I mean, there's several measures that we're looking at being implemented. And I mean, it's difficult to say what the administration might do, but taxing capital investments in the U.S. And making it more difficult for foreign investors doesn't necessarily sound conducive to a good open market environment when you're trying to attract some of that investment. So I'm not going to say anything's off the table here, and I'll leave it up to the politicians to negotiate that.
I don't blame you for being cautious. I know that Eric Lascelles at Royal Bank, quoted by Dow Jones, actually is saying he thinks countries will ultimately walk away from their digital services taxes on the US internet giants, but it'll be tough politically for Ottawa to do that.
Well, I mean, obviously, there's going to be a lot of negotiations that happen, and we've seen, Prime Minister Carney, he's starting off on a very strong relationship, it looks like, with President Trump. There's a lot of negotiations that are going to come under play, and again, if you're talking about political pressure versus economic reality, that's a balancing act that we're going to have to make. Prime Minister Carney has a lot of things that, he can try and take care of domestically. Interprovincial trade barriers obviously is something significant that we would like to see some measures on. And digital service tax, I'm sure that's going to come into the renegotiation of the USMCA as we get into that towards the end of the year.
Yeah, it seems to be a real sore point in Washington. Okay. Thank you very much, Neil, for joining us.
Pleasure to be here.
Neil Linsdell, Head of Investment Strategy at Raymond James.